Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Hi again, this is John Moss. We're going to be starting in just a few minutes. Jeff Soule is going to be leading this webinar on the ISE versus the Dow Jones in 2008. He's going to review some of the methodology that he used in writing the white paper and take any questions. So we should be starting in just a few minutes. Some people sent some messages saying that you can hear me, so that's good. And Jeff will be on just a few minutes. Bye.
Good afternoon, everyone. Thank you for joining us today. For this webinar, my name is Jeff Soule, and I'm the head of market data for the ISE. Today, we're going to review the paper very briefly on the ISE index versus the Dow Jones for 2008. We've done this webinar a few times now, and rather than go through everything that's in the white paper, what I'd rather do this time is talk about the different methodologies and other ways of analyzing the data. The reason I say that is because I think it's valuable to see some other ways of looking at the data and see what the results could be, because they certainly are different depending on how you look at it. I just got a message that people cannot hear me. Is that correct? Okay. Overall, it appears everybody can hear, so I'm going to keep going. I thought somebody said that he lost audio, but okay. So anyway, so here we go. Let me move ahead. All right, so introduction I just covered. We're going to do a disclaimer quick. The ISE overview, comparison for last year, and then the real focus is going to be on the methodologies for analysis today. And we'll go through a quick conclusion and question and answers. If you have questions as we go along, please type them into the chat or to the Q&A box in the WebEx view. Thanks. Okay, this is our standard disclaimer. Obviously, options certainly have risk. Although this is not specifically about options, it's about an index. It's what we always use for any of our webinars. Should you need the prospectus or request any information, you can dial this number or go to the website for 888options.com. All right. All strategies discussed here, including examples, are basically strictly for illustrative purposes. Okay. Let's go ahead. The white paper for last year, pretty much standard white paper that we've done. It talks about the methodologies or the performance of the ISE versus the performance of the Dow. We had done previously comparison of the ISE versus Dow versus the S&P 500, and there was very little difference. So we just went back to doing just the ISE with the Dow Jones. You know, again, I don't want to spend a lot of time on this, but you saw the typical results. The you know, the very low values, ISE values that happen in clusters where there's 2 or 3 days, consecutive days in a row, tend to mean the market's about to move higher. Again, ISE is a contrarian indicator. And then when we have clusters of high values, it tends to have a market change direction into a lower direction rather than a higher direction. So again, very much a contrarian indicator. You know, you saw the formula in the white paper. What we use, customer opening long trades only for the ISE. It's so customer opening long positions and put positions divided by, customer opening long positions calls divided by customer opening long positions puts times 100, and that's how we come up with the ISEE value. Okay. Now, one thing we had spoken about here in this white paper was the different analysis can show different results. And specifically here today, what I think I'm going to show you is different analysis using a different time frame, which we mentioned here, different analysis using different thresholds for the high and the low values. And then also what I'm going to show you is the difference of using all securities versus using equities only. Okay? Go on here. So one of the things we mentioned when we did the last white paper, this was kind of a interperiod last year, we did a webinar on using the ISE data through the versus the Dow Jones through August of 2008 of last year. And you'll see one thing we mentioned in that white paper, this comes directly out of the white paper in the red here. We said an area to watch, however, was the end of August, where we saw 3 consecutive highs in a row on August 21st, 22nd, 25th. And at that time, the market had already been down 14% on the year. At that point, the Dow was at 11,386. And I think it's pretty clear what direction the market went from September on of last year, especially after the Lehman collapse, and the market went straight down. But what I think is interesting here to note is when we did this analysis, again, we only looked at the 2008 data from January through what was at the time we had September 3rd. So these 3 consecutive values were certainly showing up. All right. However, when we did the 2008 year in review, you'll see consecutive highs never showed up in this analysis. We have highs in December, May, and April, but nothing in August. So it led me to look a little further into maybe other ways of looking at this data, because if you follow the data on a day-to-day basis and you saw the 3 consecutive highs, and you acted upon it because you felt like this was a good indicator, or you use this indicator with multiple other indicators, and other indicators were indicating oversold or overbought positions as well, you might have acted upon that data. So here is, and again, this is just, you can download this data from our website. When you download the data, you can open it up in Excel. So here all I'm doing is, when we initially do the analysis, we dump the data into Excel, all right? And then, as I said, we use the 10% highest values and 10% lowest values for no other reason than we just felt that other people, professionals that write about put-call values that I certainly respect, seem to believe that the put-call values are very useful at very high or very extreme values, not very high values or very low values. So, when we said, well, how do we determine for the now purpose of our white paper what values we use, we just said, nothing scientific here, nothing statistical. We just said, okay, let's just focus on the 10% highest values and the 10% lowest values. So we dump the numbers into a spreadsheet. We sort them by high and low, and then anything in this pinkish or red color would have been the 10% highest values, and anything that's going to be in the 10% lowest values will be in a light green color. All right. So when we did this analysis for the first 8 months of the year last year, we had these 3 consecutive high values on August 21st, 22nd, 25th. There's a weekend in there.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.